Namaskar friends, welcome back to the channel. If you have not yet filed your income tax return for assessment year 2026-27, then this video is extremely important for you. The original due date for many individual taxpayers filing ITR 1 and ITR 2 was 31st July 2026, which has already been passed. However, do not panic. A belated return can still generally be filed up to 31st December 2026, subject to the applicable provisions. And in today's video, I am going to explain what happens if you miss the ITR deadline, how much late fee is payable, does late fee depend on tax payable or total income, what happens if your tax liability is nil, what is section 234A interest, can you carry forward business and capital losses if you file late, what happens after 31st December 2026. Besides that, we will discuss the new form 141, particularly schedule B for purchase of immovable property above 50 lakh. So watch this video till the end. Which year are we talking about? First, let's understand the terminology. We are talking about financial year 2025-2026 and assessment year 2026-2027. So, income earned from 1st April 2025 to 31st March 2026 is reported in the ITR for assessment year 2026-27. The Income Tax Department confirms that taxpayers should select assessment year 2026-2027 when filing the return for financial year 2025-2026. Now, the due date depends upon category of taxpayer. For many individuals covered by ITR 1 and ITR 2, the due date was 31st July 2026. For certain non-audit cases covered by ITR 3 and ITR 4, the due date is 31st August 2026. So, if your due date has not yet expired, don't wait. File your return as early as possible. Now, what if you miss the due date? Now comes the most important question. Suppose your ITR was due on 31st July 2026 and you did not file it. Can you still file it? Yes. You can file a belated return under section 139 subsection 4 generally up to 31st December 2026 or before completion of assessment year, whichever is earlier. But there can be financial consequences. There are primarily three things you need to consider. Number one, late fee filing. Number two, interest on unpaid tax. Number three, loss of certain loss, carry forward benefits. Excuse me. Let's discuss each one. Late filing fee. This is where there is a lot of confusion. Many people believe that the late fee depends on the amount of tax payable. That is not correct. The late filing fee is linked to total income, not simply the amount of tax payable. For assessment year 2026-27, the official income tax department FAQ states if total income is up to 5 lakh, late fee is 1,000. If total income exceeds 5 lakh, late fee 5,000. So let me give you an example. Suppose Mr. A has total income of 7 lakh. Okay. Then after rebate and other applicable provisions, his final tax payable may even be nil. But if he was required to file the return and files it late, the late filing fee can still apply because his total income exceeds 5 lakh. So remember this important point. Nil tax does not automatically mean nil late filing fee. The obligation to file the return and the calculation of late fee need to be considered separately. Now friends, there is an important correction I want to highlight. The report shown in the screenshot says new tax regime up to 4 lakh no late fee, 4 lakh to 5 lakh 1000, above 5 lakh 5000. Do not use the 4 lakh figure as the section 234F late fee threshold. The Income Tax Department's current FAQ specifically states that assessment year 2026 and 2027, total income up to 5 lakh 1000, total income above 5 lakh 5000 as a late filing fee. The rupees 4 lakh figure associated with the new regime tax slab basic exemption and should not be confused with the late filing fee threshold. This distinction is very important when you are advising clients or preparing ITRs. Now let's come to interest under section 234A. Late filing fee and interest are two different things. Interest under section 234A can arise where tax remains unpaid after the original due date. Got my point? Interest under section 34A can arise where tax remains unpaid after the original due date. The commonly applicable rate is 1% per month or part of month on the relevant unpaid tax amount. For example, suppose after considering TDS, advance tax and other credits, you still have 50,000 tax payable. If applicable, interest may arise for the period from original due date until the actual filing or payment date. Therefore, when filing a belated return, do not just look at the 1000 or 5000 late fee. Also check whether there is any interest liability. And remember, late fee and interest are separate liabilities. Now, this is extremely important for businessmen and professional investors. What happens to business and capital losses? Suppose you have business loss 3 lakh or capital loss 2 lakh. You want to carry this loss forward to future years so that it can be adjusted against eligible future income. Generally, to preserve the benefit of carrying forward certain losses, the return must be furnished within the prescribed due date. If the return is filed late, certain losses cannot be carried forward. This includes, subject to the applicable provisions, business loss, speculation business loss, capital loss, certain other specified losses. However, there is an important exception relating to loss from house property, which can generally be carried forward even where the return is belated, subject to the applicable rules. If you have loss, do not wait until the last moment to file your return. Even if there is no immediate tax payable, filing on time may be extremely important for protecting your future tax benefits. So what happens after 31st December 2026? Now another very important date, 31st December 2026. What we'll do? For assessment year 2026 and 2027, a belated return can generally be filed up to 31st December 2026, subject to the statutory conditions. But what if you can discover the mistake after 31st December? This is where the rules becomes more complicated. The revised return provisions and updated return provision need to be considered separately. The Income Tax Department also confirmed that for assessment year 2026 and 2027, revised return provision have changed, with revised return generally being available up to the end of the relevant assessment year, subject to the applicable additional fee where relevant. So don't assume that I can simply file a belated return anytime. You should check the applicable provisions before proceeding. New Form 141 for property purchase. Now let's come to the second major update in your report. If you are purchasing an immovable property during financial year 2026-27, there is an important change in the TDS reporting mechanism. Earlier, buyer generally dealt with a Form 26 QB for TDS on purchase of certain immovable property. Under Income Tax Act 2025, a new consolidated Form 141 has been introduced. Form 141 consolidates several earlier transaction-specific TDS forms, including Form 26QB, 26QC, 26QD, and 26QE. Form 141 has 4 schedules. Schedule A, TDS on certain rent payments by individuals. Schedule B, TDS on transfer of immovable property. Schedule C, certain payments by individual and HUF to contractor or professionals. Schedule D, TDS on transfer of virtual digital asset. Today we are particularly interested in purchase of property above 50 lakh. If you purchase an immovable property other than agricultural land and the consideration exceeds 50 lakh, the applicable TDS provisions need to be considered. The Income Tax Department's Form 141 guidance specifically states that Schedule B is used for TDS on transfer of immovable property, and that TDS is required where the property value exceeds 50 lakhs. The buyer needs to provide information such as property details, address, date of agreement, registration date where applicable, stamp duty value, total consideration, payment mode, seller's payment / credit details, TDS detail, etc. The new process is through the income tax e-filing / e-pay tax system under the Form 141. Simple example. Let's understand with an example. Suppose you purchase a residential property for 80 lakh. Since the consideration exceeds 50 lakh, the buyer needs to examine the applicable TDS requirement. Under new system, instead of looking for the old Form 26 QB process for a transaction falling under the new regime, the buyer should use the applicable Form 141 Schedule B process. The buyer should collect the seller's PAN and enter the required transaction details correctly. And remember, don't wait till the last day. Property transaction involve multiple dates, buyers, sellers, installments and documentation. So friends, let's quickly revise today's 5 most important points. Point number 1. For financial year 26-27, if you have missed the original ITR due date, a belated return can generally be filed up to the 31st December 2026, subject to the applicable provisions. Point number 2. For section 234F, don't confuse the tax slab with the late fee threshold. For assessment year 26-27, total income up to 5 lakh, the fee is 1000. Total income above 5 lakh is 5000. Point number 3. Even if your final tax liability is nil, you should first determine whether you are required to file the return and whether late filing consequences apply. Point number 4. Belated filing can affect the carry forward of certain losses, particularly business and capital losses. Point number 5. For financial year 2026-27, Form 141 is the new consolidated TDS Challan Cum statement, and Schedule B deals with TDS on transfer of immovable property above the applicable 50 lakh threshold. So if you found this information useful, please like this video, share it with your friends and colleagues and subscribe to the channel. If you have any question regarding ITR filing, late fees, section 234F, section 234A, loss carry forward, Form 141 or property TDS, write your question in the comment section. I will try to cover the most important question in the next video. Thank you for watching. Stay compliant, file your return on time, and keep your tax records properly reconciled. Jai Hind. Thank you for watching. Thank you. Good night.